One of the biggest mistakes beginner traders make is thinking price is breaking out, when in reality it's just taking out liquidity before reversing. If you were ever taking a trade and the market stopped you out by just a few points before going exactly where you thought it originally would, then this video is for you. Today we're going to talk about liquidity sweeps, one of the most important concepts you will learn if you want to stop getting trapped and tricked by the market. Make sure you like, comment, and subscribe for more videos like this, and let's jump straight into the charts. Alright guys, now before we start, remember, in the last video we talked about what liquidity is. Today we're going to be taking it one step further and looking at what happens when price actually goes to grab it. Alright guys, think about a swing high. And if you guys don't know what that is, that's literally what we're looking at right here. Okay, so a lot of traders see this swing high and think, if price breaks above it, I'm buying, right? Let's say they're imagining, okay, we get a bullish candle right here and price goes above it. Well, they're buying, right? But there's another group of traders you guys have to remember, right? And those traders already bought earlier. So where are their stop losses? Well, their stop losses are probably below these lows, guys. And the market knows this. So instead of immediately continuing higher, guys, price will often push into the area full of all those orders, trigger them, and decide whether it wants to actually continue or reverse. Now, we don't get a full sweep here, meaning where we fully went through the liquidity, but you guys still see the thought process of the market where we have stop losses below these orders and liquidity is waiting up here. So usually we'll come up like this and then take out all of these stop losses to continue lower. And that's what we call liquidity sweep. All right, guys, look at this swing high right here for a better example. So what happens, guys? We literally come up, right? Come up and then we sweep downwards. If you guys see right here, we come up, take out the liquidity with that wick and sweep downwards. Now what happened and what's truly going on? So remember, people have their stop losses down here. For the people that were originally buying on this order, their stop losses are probably somewhere down here. So market says, okay, we're going to take out this liquidity, but then take out all the orders down here. And that's exactly what happens. And that is another example of a liquidity sweep. Why does it happen? Well, this is something a lot of beginners misunderstand. A liquidity sweep doesn't automatically mean price is reversing, and it also doesn't automatically mean price is going to continue in that direction. It simply means liquidity has been taken, as you guys see in this example right here. This is liquidity being taken from this swing high. But the thing is, guys, what happens next depends on market structure and higher time frame context and confirmation. So don't make the mistake thinking every single time you see a sweep, it automatically means to press buy or sell. All right, guys, let's take a look at a bullish example here. So we're going down to this swing low, right? What's going on here, guys? So price was making lower lows. We get this low right here, but then we are creating liquidity with this low, right? What happens, guys? We sweep it and then we go back up. And then we actually end up sweeping it again, then going back up again. So you see there's multiple retracements coming from the same exact swing low from over here. Now always understand, guys, every single time you guys see a sweep doesn't automatically mean to press that buy button, because you still need other confirmation to actually confirm if we're going higher. Understand, guys, all this original sweep is telling us here is that market is now interacting with this liquidity, but it doesn't mean that it's going to continue, and it doesn't mean that it's going to reverse up without confirmation in context. Now let's take a look at a bearish example. So right here, guys, we have a swing high, and what happens, guys? Price is moving higher, and then we push above these previous highs, which was where the liquidity was resting. And seconds later, what happens? We fall back under price, sweeping this previous liquidity. Now, once again, the moment we sweep this liquidity doesn't mean you automatically hit the sell button. It's just the market giving us step one of that information. The biggest mistake beginners make. The biggest mistake beginners make is just trading off of liquidity sweeps alone without context. So look, for example, we have liquidity right here on this swing low, and we sweep it. Now, okay, let's say if I was in the mindset of a beginner and said, okay, we're going down because we swept this liquidity. Well, as you guys see, we would have got stopped out, right? All right, now let's say someone said we're automatically going back up because we took out this liquidity. Now, similar to the bearish example, yeah, we go down, but say your take profit is much higher, right? You don't really get a valid move up. Okay, how do I personally use liquidity sweeps? Well, first thing first, guys, I don't chase them. I don't blindly trade every single one that I see. I simply take a mental note of what's going on in the market. For example, at this swing high, liquidity has been taken. Do I immediately say, okay, we're going to sweep downwards? No. Do I immediately say we're going to continue up? No. But what actually happens, guys, we continue up, which shows that now every single time we sweep it, we actually end up reversing. Okay, now let's say I get some sort of confirmation right before we swept this, and that aligns with the sweep. Then, okay, maybe that point I would hit that buy button. And FYI, a box is obviously not a confirmation, guys. I'm just giving you guys a very basic example of understanding the steps of these basic things. All right, guys, I'm going to give you guys 3 examples of liquidity sweeps just so you guys can really get it down and understand what they are and how to find them. So over here, guys, we have a swing high. What happens, guys? Let's see if we end up going into it. All right, we end up sweeping into the swing high. What happens? We reverse. And that, my friend, is liquidity sweep. Example 2, guys, we have a swing low here, right? What happens, guys? We end up tapping into it and then sweeping upwards. That is also a liquidity sweep. All right, guys, we have another swing low over here. What happens, guys? We retrace all the way into it, we tap into it, and we have a reversal up. That is also liquidity sweep. Now, it's very weak when we don't get a long continuation going upwards after it, but we do get some sort of small retracement with these green candles right here. All right, guys, to wrap this video up, so today we learned what liquidity sweeps are, why they happen, and why sweep alone isn't enough to trade off of. If you understand liquidity, and now you understand liquidity sweeps, you are already starting to think about the markets differently from most beginners. In the next lesson, we're going to continue building on these concepts so everything connects together. If this video helped you, leave a like, subscribe if you're enjoying the series, and if you have any questions, make sure to drop them down in the comments. I'll more than be happy to help you guys. I'll see you guys in the next episode. I love you guys. Stay blessed. Peace.